Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please take your seats. Our program will begin now.
Good morning, everyone, and welcome to Bloomberg's The Future Investor, a new investment class. I'm Janet Wu, a Bloomberg anchor and reporter based here in Boston. Whether you're joining us here in Boston in person or joining us virtually, and we have a huge audience joining us virtually from all over the country, we are so excited to be with you. Recent studies show Gen Z and millennials are earning more and investing at a higher rate than previous generations. But this new class is also getting their first real test of a first downturn with market volatility and softening valuations. Their investing potential, along with the pace of innovation, is set to be exponential. So whether you are investing as them, for them, or with them, young investors will have a major impact on society and the world of finance. Today, we are going to take a look at how they are consuming information with trends, sectors, and asset classes they find most attractive. We'll explore the technologies they are embracing from both a consumer and an investment perspective. And for that, my colleague from Bloomberg Intelligence, because I can't do this, will take us into the metaverse. As you know, we are gathered right now during a tumultuous time in the markets. So we have a great panel on the current risks, opportunities, and global economic headwinds for investors of all ages, not just the younger ones. Before we get started, a few announcements for the event. I would like to acknowledge our U.S. presenting sponsor, Invesco QQQ. We will hear from them later in the program. For our virtual attendees, if you experience any problems with your audio or video quality, just try the old-fashioned thing first, refresh your browser. You can also use the chat box at the bottom right corner of your screen for support. If you would like a real-time transcription of this event, just click the link in the session's description. And for everyone, virtually and in person, we want you to be part of the conversation. Submit your questions via the Q&A function, the white tab on the right side of your screen, and I will get to as many of them as possible because, as you know, we have some rock star panelists with us today. Please also engage with us on social media. This is targeted to younger investors, right? So we have to keep up with them on that front. You can use the hashtag #TheFutureInvestor, where you can also follow the day's highlights. And we will also be posting highlights and content under the handle Bloomberg Live. And also feel free to tag us in your posts. So now we are ready to dive in. Please join me in welcoming Stephanie Dobson of Putnam Investments, portfolio manager of its Sustainable Future Fund and the Putnam Sustainable Leaders Fund, Steph Guild, head of investment strategy at Robinhood, and Amy Zhen, portfolio manager at Alger, where she invests in small and mid caps. Thank you so much for being with us this morning. So I want to start with a general question for all of you, and it's sort of the obvious one for this panel. From your vantage point, what makes the younger investor different from, say, the investors of a certain age? Amy, I'm going to ask you first.
Well, I think the younger generations, they are digital natives, so they really prefer, for them, convenience is very important and a sense of bargain. And also, they like to invest in company that they believe in, so they have very strong morals, and they like to see sustainable growth. And also, company can grow from, as we say at Alger, exceptional small company, have the wherewithal, become exceptional large company. I think all those resonate with them.
Stephanie?
Yeah, I think that's a great point, and thanks for having us. I think that what's really interesting about younger generations is they're definitely consuming differently. I recently read a stat that 75% of Gen Z, and it's a close number for millennials too, are interested. They prefer purchasing sustainable brands, and a third of them are actually willing to pay more for those sustainable brands. 40% of Gen Zers prefer to socialize virtually, which blows my mind personally. And so I think all these ideas that younger generations actually consume differently, for us, that impacts companies, which impacts the stock market. So as investors, we should care about it. So it's this really interesting circle that as fundamental investors at Putnam, we think a lot about.
I'm so excited to start asking you about some ESG issues in a moment. But first, Steph, you are with a platform that is known for attracting younger investors. So what makes them different?
We've done a lot of research on our users, and I would agree with a lot of the points that were just made. We see actually from the user research we've done, specifically on the Gen Z generation, for example, is that they feel like they're the smartest generation because they have access to so much more information than previous generations did. About 28% of them get their information from social media versus 10% of Gen X generation. So they do have access to a lot more than previous generations did, and they're using it to hopefully build wealth for a longer term.
So let's talk now about what they find attractive. And Stephanie from Putnam, we know, or we tend to think of them as being more socially conscious, and you invest with that ESG mandate. What do you find most resonant? Before, it seemed like it was the E. Is it also equally the S and the G now?
Yeah, great question. So the way that we think about investing and running our sustainable portfolios at Putnam, I think, aligns well with this idea that different ESG issues matter for different companies and likely for different investors too. So for example, as I was speaking about earlier, for a consumer company, we may pay attention to the idea that consumer companies that have more sustainable packaging or lower environmental footprint, that matters for the business fundamentals and probably matters for the end consumer too. For a healthcare company, we pay attention to, because we think it matters for the business, pricing philosophy, access to care. Are you actually saving lives, creating something innovative? And so I think that these E, S, and G issues matter to different extents differently across different companies, and the end investor is really aware of that. And so at Putnam, we take that kind of context-specific approach, and as active managers, we look at different companies on a one-by-one basis to understand what matters to those businesses, and therefore what ultimately matters to investors. So all of the above, and it depends, is the answer, I think.
And speaking of individual companies, Amy, you're constantly looking for those small and mid caps with an emphasis on innovation. And you were saying that you have been attracted to some of the companies that you find younger consumers are attracted to.
Yes, for example, Wingstop, which we think is really of course it's a chicken wing company, but it's really a technology company that sells chicken wings, and that really resonates with the younger generation because I think for them it's important to have a good bang for the buck, sense of bargain, and also Wingstop has been a cutting edge of innovation in terms of digital. They are 65% digital, now they want to go to 100%, and also delivery as they are with both Uber Eats and a DoorDash. So that clearly, that's a brand that really I think is a quintessential millennial and Gen Z brand that will also be very sustainable over long term. The other company, for example, is Sprout Social, which is really a company that specializes in the social media software. As you know, millennial and Gen Z, as younger generation, being digital natives, they are really revolutionizing social media, and so that's very important. So important for companies to connect to this younger generation through Sprout Social.
Thank you. Steph Guild of Robinhood, as we were talking, your platform has attracted younger investors. Actually, I wanted to ask you some specifics about that. Do you have some numbers on the demographics, the average age, and how many new investors you added during the pandemic?
Yeah, we added, we ushered in a new generation of investors. We've got over 20 million investors on our platform. About a third of them are Gen Z. Just under 40% are millennial. We do have some Gen Xers too. Over 20% are Gen Xers.
For diversity, a few Gen Xers in there.
We do, I'm one. We do actually have quite a bit, a diverse set. Definitely errs on the younger side, which makes sense because it's a completely digital, easy to use platform. And we recently launched the Robinhood Investor Index to actually understand what they're investing in and why, and sort of track that over time and give them that same information, because everyone's always interested in what people like me are doing, not just me personally, but it's been extremely interesting because it resonates very well with what my panelists had said about what younger investors are interested in investing in.
As a follow-up question, we tend to think of younger people as being a little bit more fickle. So you had a lot of new accounts open during the pandemic, as basically every trading platform did. Have you been able to retain them?
Yeah, we have, I think it's something over, we still have over 20 million funded accounts, and something like maybe over 10 million monthly active users. So we definitely have been able to retain them. They're invested. Obviously, this market environment has been a tougher one, but I do think that what we're seeing is Our customers are learning from this and actually using opportunities to add to the positions they believe in with the market down.
Stephanie from Putnam, I believe that you mentioned earlier about how you interface with them, that they tend to find more information online digitally. How do they contact you, or are they? Are they never picking up a phone? Do you hear from your younger investors?
Sure. Steph might be better at answering this than I am, but our younger investors are interested in long-term investing, I think. As a portfolio manager, I don't have direct contact with our end customer as much as maybe I'd like sometimes. But I think what's really interesting about how the younger investor wants to communicate, I've heard that we don't like phone calls, and younger generation, we prefer emails or texts. But I think the idea is they do want constant kind of feedback on how portfolios are performing. But I think what's most interesting is, theoretically, a lot of younger investors have this long-term time horizon that they're interested in, and we hear that from clients. And I think that's so well aligned with some of these sustainability issues that they care about, that we've been talking about, often have these long-time horizons over which they play out. And so as long-term investors, we're really focused on communicating to our clients and hearing back from them how those three kind of long-term elements are really well aligned.
Amy, I'd like to ask you the same question as far as interface. I know that all of you are very busy managing money and you don't exactly interface with all of your investors, but from your vantage point, what do you see that is different about how they want to communicate with you? Because they do ultimately choose each of you as a platform.
Yes, well, according to a recent Barron study, that stocks is still the preferred sort of investment option for younger generation investors. So I think, for our younger generation investors, that they will probably prefer more digital platform, but it's more important that they want to invest in company that they know and they like. So positive brand, and we really, at Alger, we really focus on sustainable long-term growth, and we invest in positive dynamic change. I think all those elements really resonate with them.
Stephanie, I want to ask a follow-up question to you about something that you brought up, which is the obvious. With a younger investor, they have the luxury and the benefit of a long timeline if they use it. So especially also with ESG, as you pointed out, it often takes patient capital. How do you think we can communicate or teach that new investor class the importance of patience?
Oh gosh, that's such a good question. I think, as Steph pointed out, the volatility we've seen over the past, not just months, but years, is in itself an important lesson. There's some discouraging stats about how, with retail investors, we don't do a good enough job in our industry helping them stick with it, through downsides. And there's too many investors that buy at the top and sell at the bottom. And so I think we can continue to communicate, and at Putnam we try to do this very much, the benefit of long-term investing. And companies and investors that have a long-term view often can compound growth. As you pointed out, a lot of these sustainability issues that we care about at Putnam, that our end clients care about, take some time to play out. And some of the greatest stocks are those that are steady compounders over time. I will say it's really, really hard to get trading and investing right over the short term. It's more interesting, I think, personally, to try and have a time horizon edge or an analytical edge over the very long term. And so we try and just remind our clients of that. And I think they're seeing it throughout the volatility we've had over the past couple of years.
I would agree with that. We see it in our data. Our customers are investing in what they know and use every day. They also have a strong allocation to electric vehicles in all different formats. And they've been adding to these positions in this current time horizon. So maybe it's not working this year, but they have the time horizon that they need.
Can you share some more data with us? Because again, that idea that younger people might be fickle. This is also the first downturn. Are they going to pull their money and buy a video game? That's what older people might guess they would do. You're saying it's the opposite.
Yeah, we are seeing people adding into the top positions that they've been holding. Tesla is obviously one of them, but then there are other electric vehicle areas that they're adding to. They're adding to Apple and Amazon and the things that we all know and use every single day. And actually what I sort of hear a lot is, I'm just not going to look at it. I'm just going to keep doing it. And we actually have something called recurring that allows you to just keep automatically adding to positions that you want to, which is, I think, a fantastic tool for times like this.
You are with Robinhood, so I do have to bring up something that I know everyone is thinking about, and that is the meme stock phenomenon, because a lot of that did play out on Robinhood. Do you think that this is something that's going to stick around? Will we keep seeing this, or is this a fad that is going to slowly die out?
I mean, it has certainly decreased in popularity. I mean, we've seen it in the data. That, you know, AMC, however, and APE are part of our, you know, highest holdings, and so, you know, a generation of investors believes in that. That being said, I don't think the concept of investing in what you believe in and using it as almost a vote is something that necessarily will go away with the greatly increased access to investing. I think that is something that, you know, company CEOs will start to have to think about as like an entirely new investor base, perhaps, besides institutional.
And it is a way with voting with your dollars and also voting with your emotions and dollars. I'm going to hold off on asking you about crypto for just a moment, let you think about that, and I'm sure the audience is curious as well. Amy, I want to ask you that question similarly as far as voting or using your dollars with passion. I know that you've said that the kinds of companies that you think younger investors are looking for, do you think that they tend to say, I'm going to put money in not just for returns, but because I feel very strongly about something, whether it be a product that they love or maybe a point that they are trying to make?
Yeah, absolutely, because I think one thing they have in common with what we do at Alger for small mid-cap is really about being very futuristic, very long-term. And we're looking for a company when growth is not priced in, and a company that do good to the world, right? You know, we invest in companies that save time, reduce cost, increase efficiency, and I think all those resonate with them. So for them, they absolutely want to invest in companies they, you know, feel very positive on, and also they want to see those companies to grow, right? And can those companies to be around for a long time? And so to that extent, they are the you know, the ideal long-term investors, because they really looking at 5, 10 plus years, which is exactly what, you know, you will want to see, because small companies do not grow in a straight line, and we're looking for that, you know, sort of an inflection point, and I think that resonates with them.
All right. I would like to encourage our audience in person or virtually, if you'd like to submit questions, I will try to get to them in the conversation. Stephanie from Putnam, question about ESG. Overall, for investors of all ages, this is something that is part of every conversation, not just funds that are specifically targeted to ESG. Every time we look at an individual company now, this comes into the conversation. And I want to ask you, are you finding that younger investors are getting into ESG funds at a higher percentage, or is it about the same for investors of all ages, including the older investors that have been investing in funds for decades but are now switching their money over?
It's a little bit of both. So 80% of Gen Z, and the number is slightly lower for millennials, are interested in incorporating ESG into their investment philosophy, and 70% is more than a little interested, so a lot interested, right? So I think that's interesting. And then to address your question, though, Janet, more than half of all investors surveyed are interested in incorporating ESG. And so to me, this isn't just a young investor opportunity, it's an all investor opportunity. I think this makes a lot of sense. We see what's happening in the world. Energy security, company culture, retaining people, all of these are ESG issues that impact businesses. And if they impact businesses, then they impact stocks. And so as good investors, we should care about them. And so I think that this is a phenomenon that matters to all investors. And we've talked about, you know, using your dollars to vote on issues you care about. At Putnam, we're looking for that intersection of issues you care about and that also impact companies. And so we think there's a lot of businesses out there where leadership in these relevant sustainability issues can drive better company and then better fund performance ultimately, and lots of investors are interested in that outcome.
And I believe that I'm correct in that some of the funds that you are running, or at least your group, they were actually recast from general funds into ESG funds. That makes your work a lot more competitive because we are going to continue to see more and more ESG focused investment vehicles.
Yeah, so in 2018, Putnam transitioned two funds over to Putnam Sustainable Future and Putnam Sustainable Leaders, which are the two funds that I manage with my co-PM, Catherine Collins. And importantly, we didn't just change them in name, we completely turned over the funds. And so in practice and in spirit and in name, they are
by
sustainable
vote
funds.
too, right?
By vote too, yeah,
it was
absolutely. And so that helped us start with some scale, which is important, but also they're completely different portfolios than they were prior to that. And I do think it helps us, yeah.
And this is a trend we're probably going to see across all investment houses and platforms, that more and more ESG vehicles will be created.
I think so. I'm a little bit biased, but I think absolutely. I think it matters for companies more and more. We've seen that through the pandemic. These issues are just rising in importance, and so we should be paying attention to them.
People feel it in their wallets, the inflation, and especially gas prices. So electric vehicles should be the natural correlation to that.
I think we might be having a little bit of an issue with your mic, so I'm going to ask you to speak up. But I would, do you have any data on that from Robinhood? Are you seeing more investment dollars into ESG related companies? I think it's on.
It's on. Okay.
Oh.
It doesn't sound like it, but I can speak loudly. Yes, we are seeing a lot more dollars. Oh, there we go. There I am. A lot more dollars going into electric vehicles. The top stock in our index, for example, is Tesla. And then we've got NIO, PowerPlug, across the kind of supply chain, and even Rivian has been in there. So it's been an active space. I think as part of the index, I want to say something like 35% of it is in the electric vehicle space. And it's fully reflective of what our customers are owning. The way we built the index was based on something we call confidence, which essentially looks across people's portfolios and says how much as a percentage of your portfolio or account is held in that particular stock, and that's what drives the weight in the index. So it gives you a reflection of what people are investing in.
Can you remind us, how old is Robinhood now?
We've been around since 20, oh my gosh, this is, I think I want to say 2015.
Yeah. So we're talking about the younger investor, but this is almost like the toddler, the young kid platform. You've had to scale up a lot to keep up with the growing number of customers.
Yes, we have. We've grown the company by great leaps and bounds. We've added a lot of people over the time. Of course, we are a regulated industry, so we've added a lot of legal and compliance folks as well.
So hard turn now. I told you I was going to bring this up. Everyone's curious about this. I have been as well, crypto. So we saw this asset class zooming, and then it took a hard crash. Can you give us any insights if this is still something that is attractive to the younger investor?
Yeah, we are seeing a lot of attraction from investors. We recently added another coin. We've got 17 on our platform, but we are really careful about the coins that we add. Other competitors are over 50 on their platform. I would say that the one thing that, I didn't grow up with crypto, obviously. Most of us didn't. But as I've started working at Robinhood and learned more and more about it, I truly believe in the technology behind it. And so even if you don't want to invest in Bitcoin or Ethereum, I'm not sure I agreed with you, but I do really think that the technology is going to change the way financial transactions happen in the long term. And I think our customers understand that really well.
Amy, we've been talking on this panel a lot about the need for a strong stomach, patience, hanging in there. I just want to ask you specifically, since you look at small caps, mid caps, about dealing with volatility in this current market. I know it's become more challenging to find good investment ideas. And I just want you to give us some insight about how you are doing your day-to-day operation, how you are looking for these stocks, and also patience on your part as well as that of your investors.
Yeah, I think patience and tolerance very important for small cap investing because again, small companies do not grow in a straight line. We really look for those step function growth, and it could be extremely rewarding if we're there early and we're right, because we're really looking for company going up 2, 3, 4, 5, 10 times, more. Like we're very early investors of Shopify, and a few 4 years ago. So clearly, that's been extremely rewarding. But I think for us, it's very important to differentiate volatility from risk. And I always say we always use volatility as our friend. And buy low, sell high always works. I went to Columbia Business School, so just using Ben Graham's quote that over the short term, the market is a voting machine, and over the long term is a weighing machine. I think for the younger generation, they have time, right? Gen Z, millennials. So I think that's like the ability to take a long-term view, especially in small mid-cap space, has given us an edge, and I think will give them an edge as well because they have that time horizon. But of course, at the end of the day, still at Alger, our edge is really about stock selection. So it's really about alpha generation, and it really comes down to unearth those companies early on their corporate life cycle and watch them grow. Sort of planting the seeds and eventually see garden of flowers blossoming.
Do you think that younger investors do have more of an appetite, even some of them enjoy more the idea of risk taking?
I think it's bifurcated. I mean, part of it they do, but part of them some of the investors are very skeptical of, risk taking. And so I think they want to invest in things they believe in and really sort of resonate with our investment philosophy. Again, we invest in companies that really do good to the world, right? Like we are very, very focus on healthcare, technology, consumer. So all of those, and in healthcare particularly, for them is about having access to healthcare anytime, anywhere, including at home. Digital transformation is a really common thread for our investments, and I think that it's a theme that they really care about.
So you are saying that your younger investors are equally interested in healthcare, which I think some people would find surprising.
Yes, that's a great point. I mean, it's different in the sense, clearly, for diagnostic tools, medical devices, the demographic is going to be more aging population, but healthcare is changing, right? It's really about value-based healthcare and getting healthcare and, again, having access to healthcare anytime, anywhere. And I think that's very important for the younger investors. And we invest in companies that cater to that as well.
Stephanie Dobson, we are running out of time, but I want to ask you that same question. We were already talking about patience, and you feel that a lot of your investors already, both the younger ones and those of a certain age, do understand the need for patience with capital. But do you feel, from your vantage point, that the younger investors do have a greater appetite for risk?
So I think we see it in, Steph brought this up, you see it in retail investors in general that this cycle they've been more likely than in the past to be buying down markets, which I think is an indicator of what you're talking about. As active managers who those investors trust to manage their money, I think volatility, as Amy pointed out, is a really attractive environment for active investors. We get to reassess companies, meet with management teams, test our personal biases, test the fundamentals at often more attractive prices than we were able to in the past. And so I think that's a great opportunity. And as I mentioned, this long-term investment horizon, I think, is an edge that active managers can have. So I think that, as the market focuses on a go-forward basis on more business fundamentals and some of the macro noise maybe wanes to the background, I think it'll be really important to think about long-term earnings powers for businesses.
I have now a final question for each of you, and I'm actually going to have Steph answer last since you do have more younger investors. So let me quickly go back to Amy. This final question is looking ahead. We're in our last few minutes, unfortunately, for the panel. Looking ahead, what can you guess that younger investors are going to demand? What are you going to have to provide more of for them? Your best your best assessment?
Again, I think whatever a company that address their issues, pain points, as we say, makes their life easier. Easy is very important for them. Easy access and confident convenience, very important, and also making them feel good. They want to invest in companies, positive brands that make them feel good about themselves.
And
I think that we talked a lot about these different ESG issues. I think we didn't talk a lot about S, which I think is rising in importance. And I think both for organizations like mine and then the companies we invest in, I think investors and customers are increasingly looking for companies to be putting their money where their mouth is from a people perspective. I think today that's even more important than we've seen in the past. Treating your employees well. As Amy pointed out, health's not just important to younger investors, but mental health is really important. How do businesses support their employees' mental health? And so I think all relevant ESG issues are going to matter more and more over time, but I would just like to highlight this hard to measure but really important S issue that I think are going to matter a lot, especially to younger investors, but hopefully to all investors.
And Steph, finally, you have a platform that you are directly interfacing with the younger investors, and you also have to service them for the investment services they are seeking. What can you tell us is your best guess looking forward that they are going to demand?
I think kind of building on what both my panelists said is the intersection of advice and kind of the old school way of giving advice was through getting an advisor and a human advisor. And I think there needs to be an intersection between that and digital platforms that doesn't quite exist today. And so I think our investors are no different than previous generations in that as you grow older and your life becomes more complicated, perhaps you have children, you have to take care of an older parent, your needs change, and so delivering those needs in an easy digital fashion through advice and financial planning, for example, I think will be a new frontier.
And again, how do you think that they're going to be interfacing with you? Is it going to be through the chat bot?
Chat is popular. It's becoming popular. Phone calls are more limited versus, phone calls are usually for an emergency. But there will be lots of different ways. I think most importantly is that they want to be able to carry it around in their phone, which is why we are mobile first, and be able to be there for them when they need us, but not necessarily push things to them constantly, because I think, not just younger investors, but all investors can find that to be a little annoying. And so they want to be able to access it when they want it.
Thank you so much. I think you would agree that this panel flew by, and I really appreciate all of the insights that you gave us today. Thank you again, Amy Zen from Alger, Stephanie Dobson from Putnam, Steph Guild from Robinhood. Thank you so much. Next up, we have a sponsor spotlight from Invesco QQQ on how they are empowering today's investors. Joining us is John Feyerer, Head of Innovation and Commercialization for U.S. ETF and Index Strategies at Invesco. But first, before he comes up, please enjoy a short video.
Thank you. So good to be with you this morning. Thank you for that kind introduction, Janet. Indeed, my name is John Feyerer, and it is a pleasure to be with you here on behalf of the Invesco QQQ. As mentioned, I head up the innovation and commercialization team at Invesco, so we are responsible for delivering innovation via ETFs, and I think the QQQ is a classic example of the type of innovation that can be accessed through exchange-traded funds. What you likely know, or you wouldn't be here today, is that the newest investor class is earning more, they're saving more, and they're investing at a rate higher than previous generations, which is why we're exploring how they make financial decisions and where their new money is flowing to as applicable. So, and why we're really excited to partner with Bloomberg to deliver this session. It's a part of a series focused on the young investors. So please be on the lookout for information on events that we're hosting in Atlanta and in my hometown in Chicago. We would love for you to join us virtually for those. But at Invesco, we are committed to solving the needs of the individual investors and finding new ways for them to help realize their goals. It's why we offer a wide range of investments, including stocks, bonds, alternatives, through a variety of different vehicles, including, of course, the exchange-traded fund. So it's at that same commitment to the individual that has helped us drive our decision to partner, as we saw here today, and sponsor the NCAA. As the official ETF of the NCAA, the QQQ is in a unique position. And I just would ask a quick show of hands, how many college sports fans do we have in the audience? Yeah. I got to tell you, I get in trouble on a weekly basis for dialing in for a little bit too much football on Saturday afternoon. So, but certainly quite a few. And we are engaging with these fans and really ultimately investors in their everyday lives with no appointment needed. So it's because of the relationship with the NCAA that we've been able to bring to life something that we're really proud of. And that you just saw in that video that just ran a second ago. So at Invesco, we have a long-standing history of delivering financial education to clients in the local communities. But now we can boast a new program that brings the same level of support to college students and college athletes. As I said, we've partnered with the NCAA to bring its member institutions and its college-age students Invesco's QQQ, How Not to Suck at Money, the official financial education program of the NC2A. This program helps students and student athletes make informed decisions that will educate the next generation of investors. It's a free, interactive digital game informed by research from over 1,500 students and student athletes, and it's designed to arm those students with the knowledge to help navigate those important real-life financial scenarios with confidence. With more investment choices now than ever, it really is important that these types of resources are really vital and be made available to these soon-to-be, or in some cases, early investors. So don't play the presentations today during the program, but please do check it out. Just Google How Not to Suck at Money. It's pretty easy to remember that one, How Not to Suck at Money. My QQQ colleagues here in the room, Rob Stewart and Lynn Bertucci, if you could wave your hand there, certainly available to and happy to chat with you as it relates to this program. So, but in the meantime, thank you for coming today. Hope you enjoy the rest of the program, and best of luck to you. Thanks so much.
Thank you, John. That is one heck of a name for a fund. Spells it out very clearly. We know that the appetite of young investors for new products and platforms is driving tech disruption. And we want to focus on one area right now that most of us of all ages still find quite mystifying, and that is the metaverse. Who are the players? What is attracting the most investment? How much investment is going into the metaverse? And for all of this, I want to bring up a colleague of mine who is deep into this subject, Mandeep Singh of Bloomberg Intelligence, and also the host of the podcast, Tech Disruptors.
Okay, good morning everyone, and it's great to see a room full of people and do this in person. I mean, I've given a couple of presentations on Metaverse this year, and my viewpoint has kind of evolved in terms of, how I think about the opportunity set. So let me start by giving a background of what Bloomberg Intelligence is. For those who don't know, we are a team of about 400 people within the Bloomberg umbrella. We do our own research. We have models on companies. And what we try to do is to give our investor base and the terminal users a bottom-up perspective, fundamental analysis on companies and research. And Metaverse being an opportunity that ties closely with companies like Meta, Apple, and all the large tech names. So What I'll try to do here is to really help you kind of get a feel for how we are thinking about the opportunity set and how we are sizing this opportunity more importantly. So when, when I gave this presentation back in April, and it was in Boston as well, there were a number of definitions and forecasts that I have come across, from trillions of dollars, $5 trillion to, even more than that. And the underlying assumption that everyone is making when they're coming up with trillion-dollar forecasts for metaverse is internet is the metaverse. Everything that we do on the internet can be moved to this abstract term called metaverse, which can drive a lot of 3D immersive experiences. And I think even though I notionally agree with that definition, I do think when investors are looking at metaverse, they're more focused on the incremental opportunity. What is it that virtual reality or augmented reality or a new form of 3D experience can enable? And that is where we have highlighted 3 revenue categories that could be $100 billion type of opportunities by 2030. They're still relatively small, as you can see on the chart. But the more important thing is this is how the companies that are thinking of this concept or coming up with ways to monetize this new concept are focusing on. So we are AR hardware. We know Facebook or Meta has made a big push. Oculus, in fact, last year, they did sell about 10 million units. And I will show a comparison in terms of where it stacks up against some of the other categories like wearables, for example. And then the AR, VR software spending, that's really the next iteration of chat software, if you want to think it that way, or anything else that revolves around creating those 3D immersive experiences. And my approach when I look at the software opportunity isn't that avatar-centric as Meta has laid out to be. So their big focus is, we are going to be doing our conferences and chats with avatars. I think it can be more than that. And avatars, use of avatars is just one example of what an immersive experience can look like. So software definitely is a big opportunity. And the third one, which is established at this point of time, is the token-based, or you can call it the digital currency version of how an ecosystem can monetize the time spent. So Roblox is the most notable example where they've created their own currency, Robux. And even though it appeals more to the the younger demographic, the 9 to 15-year-olds, but they've been able to monetize it pretty well in terms of people spending their dollars, converting it to a Robux currency, and then spending that currency on the platform. So that is another way we think this concept of metaverse can be monetized. Then I mentioned about units. So this is very illustrative because you can see how all these different categories have evolved. So smartphones, for example, is like around 1.6 billion units, PCs 350 million. And when you compare that to VR and AR, VR was 11 million units. The good thing for VR and AR as a hardware category is, look, the price point is close to some of the other categories like tablets or wearables. So as long as the price point keeps going down or it stays around this level, the unit base will expand. AR, on the other hand, is still quite expensive, which is why you see the number of units is still negligible. And then smart speakers is another category that has become quite popular, and it's done quite well simply because the price point is that low. So our view is, the VR AR hardware category may bundle some of that functionality that your watch offers or the smart speaker offers, and that's where it can be more mainstream in terms of people actually buying these for not just the gaming experiences, but something more than that. This is another kind of snapshot of the market share, and you can see how Apple has created a new category in wearables. It's a leading vendor. On the smart speaker side, Amazon and Google have actually done quite well. And then on the AR and VR side, I mean, AR is still very small, but Microsoft definitely with HoloLens is a leading vendor, and Meta, we know, is the leading vendor when it comes to the VR experiences. So when you're thinking about metaverse, it's important to think of the time spent across categories. And you can see right now, social networks clearly have the largest install base, 3 to 4 billion users, spending on average, 50 minutes per day. Video platforms have become quite popular, from TikTok to YouTube, and they are kind of gaining market share in terms of time spent. At the end of the day, users have only so much time to spend on, Netflix or social media. And so when you're thinking about metaverse, you have to think in terms of the overall time spent. And that's why I think it's important to look at gaming as a category, because right now, gaming is the biggest use case for, VR and AR. And it will evolve over time. As I said, chats could have a more immersive experience, but gaming is a good comparison because you can see how much time people are spending on gaming, and that continues to grow because of the pivot towards VR and AR. This is another data point around virtual worlds, as Roblox likes to call it, and you can see that time spent is growing because people, especially in the younger demographic, they find that 3D experience to be appealing. So you can expect, there will be more virtual worlds where if for a particular type of use case or a game, it makes a ton of sense for users to spend some time in simulation and just kind of going through the opportunity in terms of learning, or education could be a big use case. So you could see similar metaverses. I mean, I don't think there will be one metaverse. There will be industrial metaverse. There could be an education metaverse, and that is the way to think about the time spent and how it could shake out. I wanted to bring this up because when you look at monetization right now, majority of the App Store sales are driven by gaming. A lot of the companies use the mobile operating system or the app stores to sell their games, and the app stores take 25 to 30% of whatever the users are spending, so that's a take rate for the platform. And that has caused a big shift from the consoles to the mobile operating system or the app stores. We think similarly, you will see a shift towards VR and AR, although not of this magnitude where mobile app stores have taken almost, I would say, mobile app stores make up like 70% of the gaming revenue. So you're not going to see that kind of shift, at least in the next 3-4 years. But clearly, there will be like a platform shift when it comes to gaming. And this is another data point around how gaming monetizes so much better than social media. So you can see the average revenue per daily active user is much higher for gaming compared to social media, although social media has a much larger base. So clearly, once you have a platform and you have engaged users, as Roblox has, you can monetize it using currency, and you can monetize it using ads, which is what Roblox is doing now. So monetization happens fairly quickly once you have users who are engaged, and all these experiences are quite immersive. So that way, you're not going to have people log into the platform and then come out of it quickly, because you will end up spending a few minutes every time you log into the platform. This is a survey that we did in terms of how VR and AR is a gateway to the metaverse. And again, the major use case is still gaming. Although with Meta really kind of making this big pivot, you can expect the social media apps will have a lot more of VR and AR type of experience, where if you are looking at your feed and if you're using a VR or an AR device, you will have a much more engaging experience, even if you are consuming a photo or a video. And so e-commerce is another kind of use case that is emerging more and more. A lot of these apps and websites do have a 3D kind of aspect to it. And if you are using this enhanced virtual reality or augmented reality headset, it will give you a different experience, more immersive. So clearly, VR and AR is being used more and more. The one kind of drawback that we are seeing is you will have, content issues when it comes to AR and VR. And I have another slide after this where it shows you that even though the VR and AR headsets have been around for about 5 years, and Meta launched their version of the App Store back in 2018, they haven't been able to grow the content very well. And there is still limited availability of content. So that's where the video game ecosystem comes into play. There are all these gaming publishers. And then what Microsoft is doing, for example, by buying Activision, is really bringing in a lot of that gaming content. Because how do you create these 3D experiences? You need some sort of an anchor point in terms of what is out there that is kind of a 3D version of what people like to kind of use in those experiences. And so the gaming publishers are very good in terms of content. Disney, for example, also has a lot of content that they could leverage for building their own metaverse. So this is a comparison, as I was alluding to. Apple App Store was launched in 2007, and you can see the number of installed devices in the first 3 years, 115 million. Contrast that with Meta, it's still a very small install base, and the number of apps at the 3-year mark was over 250,000 for Apple. It's around 1,000 for Meta. So clearly, things have been slow in terms of the adoption, and we know that, and it may very well take more time because when you think about the VR form factor, people can only use it for half an hour, and there's still, the headset is heavy, so the form factor needs to evolve as well as the content needs to grow. One area where we feel extremely positive on the software side is just the 3D design software. Even if you're not going to see, a big adoption curve, companies are investing in those 3D experiences, and that's where software will be one of the fastest growing categories, and especially the software tools that enable the 3D design, like an Autodesk or Procore and ANSYS. They will be in high demand because you are using those for simulation and design. I'll quickly go through the use cases, but you can go through the slides later on as well. Look, I think for these 3D experiences, you need the connectivity, and that's where companies like Verizon, AT&T, they will clearly require. Meta has to partner with them because they can't enable the connectivity. So for the 3D experiences, you need the connectivity, and that will drive a lot more use cases. Gaming adoption will continue to grow, and that's something we're seeing already in the data, but as the device gets better, you will see more of that. There are other use cases as well that you can see on the slide, but e-commerce, we think that will evolve as well. As I was alluding to, the websites and app will have a 3D element. And the factory floor monitoring, it's much more engaging with this kind of a user experience where you can see everything on the screen as opposed to trying to figure out where the issues are. And VR and AR can enable that. Digital twins is emerging as a big concept. More of the industrial companies are investing in it, and that really is a replica of how your factory is set up so that you can have a digital twin to monitor something like that. So these are the top metaverse players by different categories. You can see that, on the application side, Roblox, Microsoft, and 3D design software, as I was mentioning, and then semiconductors. That will be huge to enable a lot of these experiences and connectivity, as I referenced earlier. So here are my key takeaways, that VR and AR glasses are the gateway to the metaverse, even though the term is used quite loosely. Cloud and edge will enable a lot of the data to be translated into insights. And AI, look, right now social media is all personalized, so AI will have a big play in terms of driving the experiences on the metaverse, and everyone will have their customized feed, albeit it will be more 3D immersive. And a lot of the boring tasks will be automated as a result of the advancements that we are making on the metaverse. So I will be around if anyone has any questions, happy to answer that, but thank you all for listening.
Thanks, Mandeep. I always learn something from this colleague. Well, we've been focused on the next generation of investors and where they may hang out virtually. Investors of all ages need to understand the risks and opportunities in the current market, which is a challenging one. Our next panel will provide some insights. Please help me welcome Catherine Kaminsky, Chief Research Strategist and Portfolio Manager at Alpha Simplex Group, an affiliate of Natixis Investment Managers. First is Liz Young, Head of Investment Strategy at SoFi, and David Kelly, Chief Global Strategist, JP Morgan Asset Management. Another rockstar panel. Before we dive into some of your recommendations, I just have to ask David something, and everyone can weigh in. In our prep call, you were talking about how younger people perceive Wall Street, which is something we don't always think about. So even though they may be understanding the importance of investing, you think there are a bunch of myths that they need to bust.
Oh yeah, absolutely. I mean, one of the things, I've only worked really in finance, but I have to say the nicest people that I know actually work in finance. I have a young team of about 30 people around the world. They're all really nice, interesting, hardworking, very honest, very empathetic people. They just like numbers. They like expressing themselves. They find it interesting. But I think that when you look at how Hollywood portrays Wall Street, it's all about, it's sort of the Wolf of Wall Street idea. It's all about greed. And to be honest, I just don't see that. That's not, maybe I was left out of the party the whole way through my career. But
you
but I
didn't
think,
know Leonardo DiCaprio. It's on you.
But the problem is, I know that if you did a movie about the way Wall Street actually is, it would be so boring. So nobody does that. But I think particularly for younger people who are thinking, maybe I'll go into medicine or maybe I'll go into law, think about finance. There's nothing wrong with it. You're helping people grow money over time. You're helping industries grow. You'll meet lots of interesting people who are nice people who are just interested in the same stuff. So I think Wall Street gets a very bad rap from the media in general and from TV, from movies. And I think people should just take a second look at the culture of Wall Street, because I think it's a lot better than people think.
Before we start discussing investment ideas, Liz and Catherine, would you agree? Do you think that this is something that perhaps needs to be changed?
I mean, I think that's a historical look. I mean, I'm a quant, and the way that I think about it is quants are taking over. And we're sort of in a world where everything is about changing the footprint of finance and using new tools. So I really think that is sort of an artifact of the past, and hopefully people will start to see that. I mean, I know I see that in the young people that I work with, that so many of them are data scientists, programmers, and people who are excited about sort of revolutionizing and changing the financial industry.
A little bit more nerdy and less partying.
Yeah. Oh, definitely.
But you know what? They could not sell the movie. For some reason, they couldn't get a studio to sign on to that, to the quant data scientists.
Yeah.
Well, I mean, I completely agree, and thank you for making finance look better than I think it has for a while. It's just the generations that are coming into the workforce right now, it's not quite as glamorous or as cool to go onto Wall Street. It used to be really cool. That used to be the job that everybody really wanted, and now the younger generations want jobs in tech. I mean, I got into this industry because I liked math and I liked business, and it was an easy way to meld both of them. And you find a lot of people that like those similar things in the industry. And when you just look around as you move through your career in finance, it's, we all sort of hope that we have a career that continues to challenge us and we can learn every day. I think every single one of us on the stage can agree, we get it wrong often enough that I am challenged constantly, and we have to learn constantly. And the market changes so much and the economy changes that there is no shortage of new stuff to find out in this industry.
We're going to discuss the volatility and the challenges, but before we get to this, Liz, I'm going to start with you. Just from your vantage point, the younger investor, are there certain asset classes you believe they find more attractive?
Well, so we talk about the younger investor as if there's some sort of different type of animal that looks at the world so differently than the older investor, I guess you could put it that way. There are asset classes that they are maybe more interested in because they're more familiar. So they're actually not that much different than an investor from 20 years ago. It's just that 20 years ago, the market looked different and technology wasn't such a big part of it. So what they're familiar with and what they're close to and what they understand are different sectors than maybe what we did when we just came out of college. We have this, it's an ETF called the SoFi Social 50, and it's just the 50 most widely held stocks on our platform. And as a representation, our investors, 63% of our investors are between the ages of 20 and 40, so definitely a younger crowd. That ETF still has the stuff that you'd expect in it. And actually the biggest sector is consumer discretionary. It's not even tech, a lot of which has to do with Amazon. But still, it's the big names that you would expect. And then the stuff that maybe is more interesting is what I would call the woke names or the cool factor names, right? There's cannabis in there, there's meme stocks, and then the disruptors. And they're definitely more risky on that side maybe than an older investor.
David Kelly, you're chief global strategist. Are you finding that younger investors are also interested in investing beyond the US tech names?
To some extent, yes. I mean, I think when I think about younger investors, first of all, they're much more educated than their parents' generation, which I think is part of it. And also the ability to buy a stock or buy a cryptocurrency or invest in different things. It's much more easy for them technologically to access that. Having said that, we still see in investors overall just a huge fear about the rest of the world. I think that younger investors probably are less scared of the rest of the world than older investors, but in general in America, if we hear about the rest of the world, it's either tanks or tear gas or both. That's it. We get fed a constant barrage of negative news about the rest of the world, and we're told this is a scary place. So I think the younger investors, like investors in general, are probably too US-centric.
Mm-hmm. Catherine Kaminsky, you are the quant, the one, as you say, you believe you're taking over the world. Do you find that younger investors perhaps trust those algorithms more than, say, an older investor because they grew up more tech savvy?
Definitely, and I think the biggest excitement right now is there's so much information out there, there's so much easy access to it, and all you have to do is get the right tools to actually manage that opportunity set. My personal view also is that we're in an environment with a lot of obstacles, which are going to be opportunities, particularly from a macro perspective. And so that's interesting because now you have a lot more people thinking about things differently. And the greatest part about the younger investor is the younger investor has a shorter time window. So they are probably going to be able to adapt to this new changing environment in ways that we're not going to think about. So maybe they can actually innovate and find opportunities where most of us are kind of stuck thinking about the 60-40, I'd say, going forward.
Let's talk about, dive deeper into the asset classes. I don't know if, Liz, you and I had this conversation, but we were hearing that younger investors tended to hold fewer financials, hold fewer industrials. You were talking about the cool companies. Is that really something that you're seeing? And what do you recommend to them? Because cool can be dangerous.
Yeah, well, it tends to fall in a higher beta asset class. So I think, and this is my personal opinion, this is a theory, I don't know if this is exactly true, but if you think about a younger investor, the only recession that they may have lived through so far is 2007, 2008. And that completely vilified traditional financials. So then they finally are building wealth and they've got money to invest and they're putting it in their brokerage accounts and they're excited about trading. One of the last things that they're going to look at is, oh, I want to buy these big banks, right? So when you look at what they're holding, they own the stuff that's headline makers, except for some of those big banks. Now, they do actually own Berkshire Hathaway because Warren Buffett is still a legend, but the big banks are not something that they're super interested in. Some of the conversations and some of the things that I try to message to a younger investor is that just because your time horizon is really long and just because you understand these particular stocks better doesn't mean that they're going to produce the returns that you need them to, and doesn't mean that the risk tolerance is right for you. So diversification is still important. And some of the idea behind diversification, which was a phrase coined a few years ago, is that you're going to have stuff in the portfolio that isn't working at some given moment. That's what's supposed to happen. It's not all supposed to work at the same time. And you're probably going to have some stuff in the portfolio that you're not interested in or that you don't really understand why you need to own. But that is the purpose of making sure that it acts the way it should in different market environments. So it's really important to still keep that in mind.
That's a very good point, one that applies to investors of all ages. David, I'm going to ask you to weigh in on that as well, and that is the appetite for everybody, especially in this market, to understand that failures are part of the process. And again, that idea of patience through these downturns.
Well, yeah, I think that's one of the things people need to realize is it's not about making a very fast buck here. And I think the other thing, and with all due respect to quants, Catherine, I think it's very important to also look at the fundamentals, because I think one of the problems that I think a lot of younger investors get into is they get blinded by the algorithms. I mean, what could be more cool sounding than cryptocurrency? Oh, it's cryptic. How's anybody going to understand it? And it's beautiful. It's a beautifully built empty box because there's actually nothing in there. I mean, it's the equivalent of the wildcat banks of the 19th century. But I suppose if I talk to the average millennial or Gen Zer, they probably wouldn't know what the wildcat banks of the 19th century were. But the problem is sometimes people get so enthused about the technology they forget to ask price over earnings, or are there any earnings, or will there ever be any earnings, or can this company generate a fence around their earnings so they can make money over time? And it's very important to ask those fundamental questions. One of the things, one of the points I would so want to make to young investors is, do you really think that this is the best thing, the thing you're very best at, investing? Okay, that's fine. If that's what you do, good. Go off and be a hedge fund manager or a portfolio manager, great. But if you have something else, some other passion in your life, work on that and allow the markets just to grow your money. Don't try and beat the market, because there's smarter minds in Wall Street who are just going to eat you up if you just go after what you think is cool or what is most alluring or makes the front of whatever web page you look at. I think people just need to not get blinded by the concept and really look at what's it all worth.
Mm-hmm. And for Catherine Kaminsky, it may not just be a smarter mind, but a smarter algorithm. Right now is so much volatility. Many people think, oh, the quants are having a field day with this. Are you having fun?
Oh yeah, I love it. We love volatility. Volatility means that so much is happening in the world. And I think what's interesting right now is that you're in an environment where there's massive shifts and correlations between asset classes, and there's also just completely different opportunities than what you see in the data. But what's nice is that if you think about history, we like to say history doesn't repeat, but it rhymes. So there's actually a lot of similarities in the way that people behave throughout the course of history that is very similar today with just different circumstances. So I think that's interesting to me, that there's so many parallels now to what we've seen in the past, and the new investor was the old investor before. So.
Now, all three of you, well, especially David and Liz, you have to prognosticate. You're always looking forward. You're looking ahead. You have to make recommendations. So, Liz, I'm going to put you on the spot a little bit because we promised that we were going to discuss the risks and the opportunities. So let's talk about the volatility. Do you think we are at the low or getting very close to it?
Oh, gosh. I hate that question. So, first of all, I won't call lows because it's a really easy way to be wrong. What we're doing right now, I think, is approaching the June low. So the intraday June low was somewhere around 36.40 on the S&P. The closing low was 36.66, which is just an ominous number as it is, and I'd like to get rid of that. But we're approaching that. okay? And we're approaching it at a time when investors are trying to decide, do we deserve to be down a recessionary amount in the market? Now then you would ask, what's a recessionary amount? Peak to trough during a recession, usually the market is down 35 to 45%. That's a very broad average, but average. We've only made it down 24% so far in this cycle. So from the peak on January 3rd to that low on June 16th, that was about a 24% decline. That makes sense if there's no recession. A drawdown without a recession is usually somewhere between 25 and 30%, okay? So we're gonna approach those June lows, I think, this is my opinion. I think we approach those June lows, and then the market tries to decide, do we deserve to be down more than 30%? And what'll happen with the algos, and Catherine can probably tell you this better, is that we'll get there and either blow through them and go down another 5 to 10% pretty quickly, and then maybe we form a bottom, or we bounce off of that and kind of stay in this range. I would prefer, frankly, that we flush this out quickly, get it out of the system, and then find that more credible bottom, which is something that technicians will tell you. There's different measures of that. What does the bottom actually look like? We never really hit those triggers in June when we saw those lows. So if we hit those bottom triggers where you're really oversold and extended to the downside, I'd like to see that happen sooner rather than later.
I'm going to have to put the two of you on the spot as well. So Catherine, again, the algos love trying to pinpoint when this happens. So your thoughts as well.
So we tend to think that people are very complacent, and people tend to be, unfortunately, hopeful before they see the reality of what's going on. And that's exactly what we've seen this year. We're still seeing inflation at a high level compared to interest rates, and we don't think that the problems are solved. And I think what that means is that we need to get to a point where those problems are at least somewhat solved before we stop seeing more negative signals in equities. And I also believe this is not an equity story. The story is about rising rates, and it's about inflation. So once we solve that, then we can solve the equity story.
David Kelly, I want to put you on the spot. It's so timely because there is a lot of disagreement on the latest Fed hike, if it was enough. And added to the issue and the question, how much longer should the rates keep going up and for how long?
Yeah, I think, I talk a lot about lessons from history. This is a case where you shouldn't take a lesson from history. I thought it was really interesting that at Jackson Hole, Jerome Powell he only spoke for 8 minutes, but he managed to quote Paul Volcker, Alan Greenspan, and Ben Bernanke all in that period of time. And these were three giants of the economics profession. But he said, well, if you look at history, this is what happens when you have inflation and inflation expectations. I'm thinking this is a 50-year-old playbook. The world's changed a lot. And I think this is particularly important when it comes to inflation. Because what we actually have seen is headline inflation has rolled over. It peaked in June. It has come down some since then. We were at 9.1%. In June, we're down about 8.3% right now. It's going to fall further because we know the commodities are going to roll over. There is a problem. Wage growth will stay will stay strong for a while, and I don't really mind that. That's it's about time workers got to raise. But if you look at other things, shelter inflation, it's pushing up core inflation, but it's mostly nebulous because nobody pays owner's equivalent rent. Anyway, the point is, it is fading. I mean, even if you look at the Fed's own forecast, they're talking about inflation starting with a 2 handle at the end of the fourth quarter next year, and another 2 handle in the fourth quarter the following year. It took us 8 years to get down from 10% to 4% on the unemployment rate. Nobody thought that there was anything particularly wrong with that because it came down slowly. Inflation's going to come down slowly anyway. There is no point in tipping the economy into recession to fight a battle you're going to win anyway. I mean, this is not the inflation dragon of the 1970s. This is a wimpy descendant of that beast. You nick it in the foot, it's going to bleed out, and inflation is going to decline. I just think the Fed just feels like they're getting blamed. Oh, we've got to look tough against inflation because everybody's blaming us. It wasn't them. It was Trump and Biden and Ukraine and COVID, and that's what did it. It wasn't the Fed. I have a real problem with the Fed keeping rates too low for too long, but it wasn't their fault, and they don't need to be so aggressive in trying to fix it. But with regard to, and I know I'm talking along here, but just one other thing. With regard to when the market hits a bottom, I'm a very boring poker player because I sort of sit at a table and I only play a hand that I know I've got a good chance of winning. And so, fold, 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 fold. I've got to repress that, admittedly, but I try desperately. But the point is, investors don't need to play the game of picking the bottom. In order to pick the bottom, if you're an investor, you've got to do two things. You've got to know when to get out and when to get in. That's two really difficult decisions you've got to get right to get this thing right. The right thing to think about is, again, getting back to the inflation issue. If I'm right, and if 3 or 4 years from now we're looking at a slow growth, low inflation economy with the Federal Reserve having to once again reverse course and cut rates, a low interest rate environment will support a lot of long duration assets. And so what I think you need to do is just look at valuations today, figure out what's going to survive whatever recession we may or may not have, probably will have, but what's going to survive that and what looks like good value and what will look like good value a few years from now. Just, slightly overweight that stuff, stay diversified and cool it rather than trying to just time all of this.
I have to ask, what are the odds that you think we are going to have a recession?
I'd call it about I think by the end of next year, it's about a 60-40 shot. I mean, I've got a friend of mine, had another, all the people in my team are younger than me. I mean, I'm old enough to be their father. I'm possibly old enough to be their grandfather at this stage in some cases. But one of them, David Leibovitz, was saying, it's kind of like you're walking around the edge of a pool. Well, I'd say it's like walking around the edge of a pool with a boisterous kids' party going on. One bump, and we're in recession. We are being protected a little bit right now by this excess demand for labor, which is a relic of the pandemic and demographics and so forth. I don't know how real that is. I don't know how long that's going to last. But everything else in the economy is slowing and dragging on the economy. So I do think the economy is very vulnerable to recession in the next year.
So if you fall in that pool, there's not necessarily a unicorn floaty there you can jump on.
No, but that's actually important because there won't be a fiscal one. Mm-hmm. Because I think that in November, the Republicans will very likely take at least the House. And that means no fiscal stimulus between now and the 2024 election. So if the economy does fall into recession, who are you going to call?
Yeah.
It's got to be the Fed. And while the Fed now says, oh, it's all about inflation, we've got to get inflation down, that wasn't what they were saying a year ago. And it probably won't be what they're saying a year from now. And so I think while the Fed protests that they will be as tough as nails on inflation, I think a year from now, they're actually going to be forced into doing something about a weakening economy or an actual recession.
So Liz Young, as head of investment strategy, this is the beast that's over your shoulder that you're looking at when you make your decisions. What are your odds you believe we're going to have a recession?
Well, there's a lot of beasts back there. So I actually like to use a tornado analogy. I'm from Wisconsin. We had tornadoes there. So I think in these terms, when there was a tornado watch, it meant that the conditions were present for a tornado to form. When there was a tornado warning, it meant that one had been spotted somewhere in the vicinity. I think we're at warning. A recession has been spotted, so we had our 2 consecutive quarters of negative growth, but that one doesn't count because it didn't reset the business cycle. It didn't shake everything out. Inflation still went up after that technically ended. And I do think that we're going to get positive GDP growth in the 3rd quarter. So anybody that's looking at it from that definition is going to say, oh, okay, there's no recession. But we are in warning for 2023. I think the real question now is, how deep and how long will it be, and how many sectors of the economy will it affect? So we saw yesterday from the Fed their summary of economic projections, and this, unfortunately, I was reasonably bullish on the way into yesterday, but I had a list of thesis busters, and those thesis busters were, if the economic projections came out with higher inflation, higher Fed funds, lower growth, and higher unemployment, my thesis is busted, okay? Which is exactly what happened. And the odds of recession, in my opinion now, are higher. When they came out with the higher rate of unemployment, that was something that I think the market had a lot of trouble digesting because it's part of their dual mandate. It's 50% of their mandate is to maintain full employment. So it's difficult for us to look at that and say, okay, they're going to fight inflation, but they're okay with almost breaking the labor market. And that's going to be a really delicate balance. The 40% chance that we don't go into a recession is that the labor market doesn't completely fall apart.
Catherine.
Well, I think from my side, we're more of a technical signals perspective. And what you've seen this year is more negative signals, recessionary signals since the summer, particularly in the equity sector. But we've also started to see that in the commodity sector as demand has dissipated some. So I think for us, we may be kind of the ones who are always looking for that recession and always looking for that pattern. But it definitely is a pattern that we see in the data right now. And so from our perspective, maybe the chance is a little higher, perhaps 70-30, than what David was suggesting.
I think we have to recognize, though, every recession, it's kind of like at the start of Anna Karenina, the first line is that every happy family is the same, and every unhappy family is unhappy in its own unique way. And every recession is kind of unique. And what's really unique about this business cycle is that extraordinary excess demand for labor. Yeah. And we just don't know what 11 million job openings mean. Because it's one thing actually to, it takes a certain amount of effort to hire somebody to post a job opening today. Just post it. Did you take it down? In your list of things to do today, did I take down the job opening? Oh no, who cares? And so we don't know what that is. Is that real demand, or is some of it fake demand, or is it going to evaporate? That's what we don't know, and that's really what I think the Federal Reserve ought to be thinking a lot about. But again, I think they should be taking it easy here, because they're charging forward in tightening really in a very foggy environment.
May I just give a shout out that I think it's amazing that we have referenced in this conversation Wolf of Wall Street and Anna Karenina. That's just what you are attending here. All right, so strategy looking forward. We're approaching our last 6 minutes of this panel. So you've all given a greater odds of recession, 60 to 70%. So Liz, in your role of strategy, what is your recommendation? Specifically, what are you even seeing or recommending that people hold in cash right now for the moment that things get uglier, that there are the opportunities?
Yeah. So when I talk about strategy and asset allocation, it's long only. So the most bearish I'll ever get is to tell people to be in cash more than usual. I imagine that there are a decent amount of people who are in more than usual cash positions right now. If you just look at the equity outflows in ETFs over the last few weeks, with the exception of this week, there have been a lot of outflows of equity. So I imagine that people do have a larger than usual cash position. So then it's a question of, do you deploy it, when do you deploy it, and where do you deploy it? In this environment, and remember, even if we do go into a recession in 2023, the market bottoms first. The market bottoms first, then the economy bottoms. So if the recession happens in 2023, the bottom in the market likely happens in 2022, frankly, or early 2023. So this is a period where we do still have to go through this digestion process. We have to wait for inflation to come down, but that means that we could kind of grind lower for a while, in which case that's a good opportunity to drip your money in, take those cash positions and start dripping it back in. Where would you do that? This is to David's point about fundamentals. How much are you willing to pay for growth? If you look at classic growth sectors like discretionary and tech, I still think they're pretty expensive. Tech is at 20 times forward PE. Discretionary is at 24 and a half, I think, forward PE. Look at sectors like communications or healthcare. Those are trading at somewhere like 14, 15 and a half times PE, lower than the broader S&P. And then you can I would look at cyclical sectors that are also trading below, things like financials. I know if you're a millennial or a Gen Zer, you don't like those, but give it a shot. Financials, industrials, some of the places where you'd get more value, more bang for your buck.
Catherine, I want to ask you next. You're watching the signals. Again,
so this has been a fantastic year for momentum trading and for any of the themes that you see cross assets. What we've seen is some of the strongest short signals in fixed income since 1994. Someone asked me a great question the other day. They said, how come bonds have so much volatility? And I said, well, don't you know risky assets have downside volatility? You've just never seen it before. So that's sort of the way to think about it, is bonds have just been in a very positive cyclical environment for a long time. So people are going to have to watch out for fixed income exposure, both in individual assets, but also in assets that have exposure to fixed income, like growth companies and tech, where as we see higher rates, which could possibly go higher than we like, even if it's warranted or not, that's going to create a lot of opportunities to think about how that affects your investments. Secondly, the commodity sector has been at the core of everything that's going on. That means that you have to think about what's going on in the raw materials to actually understand how that's going to impact the fundamentals of individual businesses and sectors. So people are paying a lot more attention to commodities. They're also paying a lot more attention to duration exposure recently, and that's something that I think is going to continue going forward.
I'm going to give you each 1 minute. We're down to our last 3 minutes about advice looking forward. Again, so many factors: war, supply chain challenges, a volatile market, the economy that is showing signs of weakness. So David, you first. Your advice to investors right now.
Well, I think the most important advice is take a long-term view. Lift up your head, look out a few years at least. Don't try and time this. But also look around the world, particularly in Europe, actually. I mean, Europe, nobody says a nice word about Europe, and it certainly is threatened by recession, probably in recession at this stage. Ukraine war, just a lot of problems. And the euro is extremely low, as is the British pound. But there's a possibility, there aren't just black swans in the world, there are actually white swans too. And if you had some sort of ceasefire in Ukraine, European stocks will just take off. If you had a pivot from the Federal Reserve, then the dollar, which is way too high, could begin to come down, and the major beneficiary of that would be the euro. So I think that's a place to perhaps put an extra dollar, but the most important thing is just look at valuations, take a long-term view, do not try and play the ups and downs of this market unless you truly think you're smarter than the average person who spends every day on Wall Street doing this.
Liz.
Yeah, I think as investors, we have the benefit today of so much more information at our fingertips, but that's a blessing and a curse. And it's a curse in the sense that every time we get a new piece of information, we're tricked into thinking that we're supposed to do something about it. And I would urge people, especially in this environment, even though it's so tempting to chase that around and it's so tempting to do some day trading on the margins, even just look at what happened yesterday, the swings after 2 p.m. Eastern time, between 2 and 4 p.m. Eastern time. There was no way anybody was really going to catch that and get it right. So it's not going to behoove you to chase those around, and I would resist the urge to act on any new piece of information and really try to give yourself, I would call it almost a 3-week rule. When you want to make a big move, give yourself a few weeks to really sit back and think, is this how I want to change everything? And the answer is probably no at the end of that period.
All right. Well, with the markets, though, 3 weeks feels like an eternity, but I am going to employ that.
Okay.
All right, Catherine.
I think I'd have to agree with Liz, and that I'd say that emotions are very high right now, and that's why, for example, us systematic investors, we have a plan, and we follow that plan. So I think it's important for investors to also have a plan and try not to react to short-term moves, because as you know, they can change within the same day these days.
Thank you so much. I wish we had another hour to discuss with you. I would like to thank our panelists, Catherine Kaminsky of Alpha Simplex, JP Morgan's David Kelly, and Liz Young from SoFi. Thank you so much for being with us. A lot of advice and a lot of insight. Thank you again. You can catch all three of them, by the way, regularly on Bloomberg TV and radio, and you can see why. I want to thank all of our speakers today and all of you for being a great audience. Thanks to our U.S. presenting sponsor, Invesco QQQ. If you'd like more information about our sponsor, visit the resources tab on the event website. We covered a lot today. If you want to watch any of today's presentations again, you can return to BloombergLive.com, the Future Investor 2022 to view on demand. And as you heard earlier, the Future Investor Series will next be held in Atlanta on December 1st and Chicago January 24th in the new year. And for more details on that, to register in person or virtually, because there will be another slate of very interesting guests, please again visit BloombergLive.com. Thank you again for being with us. Enjoy your day.